Hello everyone. In the video lecture of cost of equity capital part 1, I have covered calculation of cost of equity capital by dividend price approach and dividend price plus growth approach. Now in the second part of this lecture, I am going to cover calculation of cost of equity capital by earning price approach and earning price plus growth approach. In the last section of this lecture, calculation of cost of retained earning is also covered. The third approach for the calculation of cost of equity capital is earning price approach. Here K is calculated by considering earning per share. So here K is the minimum rate which we have to earn on market price of a share. And it is calculated with the formula K is equal to EPS upon net proceed for new share. For existing equity, K is equal to EPS upon market price. Let's take an example based on this approach. XYZ Limited is planning for an expenditure of Rs 120 lakhs for its expansion program. Number of existing equity shares are 20 lakhs and the market value of equity share is Rs 60. It has net earning of Rs 180 lakhs. Compute cost of existing equity and cost of new equity capital, assuming that new shares will be issued at a price of Rs 52 per share and the cost of new issue will be Rs 2 per share. Here EPS, that is earning per share, is calculated by the formula earning available for equity shareholders divided by total number of equity shares. So here net earning, that is Rs 180 lakh, is the earning available for equity shareholders and number of existing equity shares are 20 lakhs. So EPS is 180 lakhs divided by 20 lakhs is equal to Rs 9 per share. For existing equity, K is equal to EPS upon market price. So 9 divided by 60, that is 15% is the cost of equity capital for existing equity. For cost of new equity capital, K is equal to EPS upon net proceed. Here net proceed is issue price minus cost of issue, that is 52 minus 2. So here K is equal to 9 divided by 50 is equal to 18%. The last approach is earning price plus growth approach. Here cost of equity capital is based on future earning and the rate of growth in earning. It is calculated with the formula K is equal to EPS upon net proceed plus growth in earning for new share. For existing equity, the formula is EPS upon market price plus growth in earning. In this example, capital structure of the company is 1 lakh equity shares of Rs 100 each. Its current earnings are 10 lakh per annum. The company desires to raise an additional fund of Rs 20 lakh on the issue of new equity share. The flotation costs are expected at 10% on face value. What will be the cost of equity capital if it is assumed that growth rate is 6% of the company? Here EPS, that is earning per share, is calculated by the formula earning available for equity shareholders divided by total number of equity shares. That is 10 lakh divided by 1 lakh is equal to Rs 10 per share. Here K is EPS divided by net proceed plus growth in earning. NP is net proceed, is the face value minus 10% flotation cost, that is 100 minus 10. So here K is 10 divided by 90 plus 6% growth in earning is equal to 17%. In the determination of cost of equity capital, second category is retained earning. Retained earning is the residual profit retained by the company for future expansion and development. So generally, company do not distribute the entire profit by way of dividend among the shareholders. Some profit is retained for future purpose. Like equity fund, retained earning do not have accounting cost but have an opportunity cost, that is dividend foregone by the shareholders. The cost of retained earning is calculated by considering cost of equity along with proper adjustment for income tax and brokerage cost. So it is calculated with this formula. Here T is the marginal tax rate applicable for the shareholders and B is the commission and brokerage cost in terms of percentage. In this example, K is 10%. The average tax rate of shareholder is 40% and it is expected that 3% is brokerage cost that shareholders will have to pay while investing their dividend in alternative security. So what is the cost of retained earning? So cost of retained earning is calculated with the formula KR is equal to K multiplied by in bracket 1 minus T and in bracket 1 minus B. Here T is the marginal tax rate, that is 40%. So 1 minus T is 1 minus 0.40. Brokerage cost is 3%. So here the term 1 minus B is 1 minus 0.03. So by putting all the values in the formula, KR, that is the cost of retained earning, is 5.82%. Now I have covered calculation of cost of equity capital and cost of retained earning. I hope you have understood how to calculate cost of equity capital and cost of retained earning. Thank you so much.